Hey everyone, and thanks for joining me today. My name is Matt, and I'm super excited about today's episode because this is where my two worlds are going to collide. That's right, we're going to be talking about investing in the stock market versus investing in real estate. Now, truthfully, that's actually not the only thing I'm excited about. I'm also really excited for you to see this intro I made using Keynote, so let me play that first, and then we'll go ahead and jump right into this episode. Well, I hope you like that as much as I did. So, to start with the comparison between these two, the first thing I want to do is talk about the similarities. Truthfully, there's not that many similarities, so this will be a real quick section here. Now, the first similarity between investing in the stock market and investing in real estate is you do have the ability to invest for income. So in the stock market, you'll see that through dividends being paid from companies, and in real estate, you'll see that through cash flow, which is really just a fancy term for people paying their rent. The other similarity between investing in the stock market and in real estate is appreciation. Now, it's pretty common knowledge that the stock market goes up and down, but you have the ability to get gains in your account from those stocks growing, and really the same happens in real estate. Now, in real estate, it's not as volatile, it's not as jumping around, but it's more of a gradual process. So you won't see significant gains in 2 weeks, but maybe if you live in a house for 5+ years, you'll really start to see the appreciation of that value. So both of them do have that ability to grow. Lastly, both of these investments do have the ability to either make money or you can lose everything you've invested. So before you start investing in either of these, I just always like to suggest make sure you do your research, you feel comfortable. If you lose this money, then it's not going to hurt you financially, and that you're just well educated with these investments and making sure that it's the right one for you. Well, that's about it. So let's move on. Now, I figured the easiest way to structure this video is just going to be doing a pros and cons for each of them and then kind of doing a final comparison at the end. So we're going to start talking about the stock market, and we'll start on a positive note and talk about the pros with investing in the stock market. So, first pro that I have is that it's really easy to get started. All you generally need is just a computer and some money to put into the investments, and that's about it. Now, I guess an additional thing I would throw in there is education. You should be a little knowledgeable. You don't have to be an expert. You don't hardly even have to be an amateur to get started, but you should be knowledgeable in what you're investing in. Just simply understanding the differences between like the Dow Jones and the S&P 500 is a great place to start. Or if that even is something that will bore you to sleep, then maybe just even looking at investing in something like a total stock market mutual fund or ETF. That way you're broadly diversified. It's one investment, one you don't have to pay attention to, and generally those are the ones that in the long term are going to be the best performers. So education's important, but it's not 100% a requirement. I would say maybe a 15% for somebody that absolutely wants to do the bare minimum with investing. The other thing, or pro, when it comes to stocks is that there's no physical work needed. Meaning, as long as you either do your research or buy into a fund, it really just takes that few clicks of the mouse to get into the position. You're not actually, if you're buying shares of Apple, you're not actually going to Apple, reviewing the company, walking around the plant, interviewing employees, anything like that. You're really just picking the company based on some information you have, hopefully, or some people are going to invest from their neighbor's recommendation. Whatever works for you. And that's about it. So no physical activity is really required for investing in stocks. The other pro for investing in stocks is that it's easy to diversify, meaning you can either invest in an ETF, a mutual fund, or you can buy just a few shares of a few separate companies and start building a well-diversified portfolio, which is what we're doing on Watchlist Wednesday, essentially making like a mini ETF. And with that, it's not going to cost a lot of money for you to do that. I would say if you're buying the stocks individually, it can really cost as much as you want it to. If you're buying an ETF though, a lot of them for a well-diversified ETF are trading around $60 to $300, which is not that bad to get started. There's also less cost associated with stocks. So a few years ago, really even like last year at this time, you had to pay to place trades. So it was something where if you buy a stock, it might cost you anywhere from $3 to like $50 to place that trade. And that was the cost that people were concerned with. Nowadays, most brokerage firms are offering free trades. So really the only cost you should be worrying about is if you're buying an ETF or mutual fund, always pay attention to that expense ratio. And also, depending on where you're investing, just see how much they charge or if they charge for an account maintenance, which is basically just you paying to use their services. Some companies do this for free if you have X amount of dollars invested in them. Others will charge you regardless how much you have invested in them. So always have that be a factor when you're picking brokerage firms, is how much is it actually going to cost for me to keep my money with them. So now let's move into the cons. Now, the very first and probably the biggest con about the stock market compared to real estate is that it's a lot more volatile. So it moves a lot more frequently than real estate does. You have, I would say, potentially a greater chance of losing your money. That's very situational, but overall, the stock market just has the chance to go up and down really quickly. And with that volatility comes emotion. So it's a lot easier to react to your portfolio based on emotion. So, if you put in, we'll call it $10,000 on Monday. Well, Wednesday, some news happens and the stock market crashes. And all of a sudden that $10,000 is now $7,000. You might decide to sell out of everything, which is going to hurt you. You're going to lose that money. It's going to be hard to get back. There's a whole thought process theory behind the days that crash is followed by the biggest gains, whatever. I forget the exact terminology that people use. But there is that lot greater chance of stocks being emotional or having emotions tied to them, which again is just something that could hurt your portfolio's performance. That's a tongue twister. You also have the chance of incurring taxes a lot more frequently when it comes to stocks, again based on those emotions. Now, what do I mean by taxes? Well, there are ways to work around that if it comes to retirement accounts, but let's just say you're investing in a regular joint account or an individual brokerage account. You would have any kind of income tax that is paid from dividends, as well as short-term or long-term capital gains. Now, taxes are something that most of you might know by now that I don't like talking about because I'm not an accountant. I worked in finance and now work in real estate. So definitely speak to an accountant or somebody with a strong tax background if you have questions on this. But short-term taxes in a nutshell are going to be taxed at ordinary tax rate or ordinary income, where long-term taxes ranges anywhere from 0% to 20%, most commonly though around 15% for long-term capital gains. And if you don't know this, short-term, less than a year, long-term, more than a year. I guess the last con that I have for stocks is that you also have less control over your investment. So let's say you invested in Luckin Coffee a while back. Well, news came out about Luckin Coffee that they had a fraud activity going on in the company and they're basically lying about all of their numbers. That's not something you as the investor can really control because that's an internal problem with the company. So you don't have direct control over what happens with the day-to-day routines. Yes, as a shareholder, you have the ability to vote on certain decisions that the company makes, but ultimately, you don't have as much control over stocks because they have their CEOs, they have their board of directors, their COOs. A lot more people have control over the way that company performs than you as the individual investor. Now, let's go ahead and move on to the pros and cons for real estate. And we'll start again on a positive note, so we'll start with the pros for real estate. Now, the first pro for real estate is cash flow. Yes, stocks pay dividends, but ultimately the cash flow that you'll see off a real estate investment should in theory be more significant than what you would see from stocks. Rents are higher than what dividend payments are. Now with that, when you receive those rent payments, you do have mortgages to pay, you have taxes to pay, you have other expenses, capital expenditures, but ultimately you'll just receive a more consistent income. Most stocks will pay income quarterly, some pay semi-annually, others only pay annually, where real estate, you're going to get it monthly. Now, that depends on the tenant as well, but in a nutshell, without going into all the details, real estate is going to be a better cash flow investment than stocks. There's also some pretty good tax advantages when it comes to real estate. So again, speak to a tax advisor. Just an example, though, of those tax advantages would be something like a 1031 exchange, where if you've lived in a property for a certain amount of time and it's your main residence and you sell out of that property, then you could and buy another property of equal or greater value, you don't pay taxes on that. So, example, you pay $100,000 for a property. When you sell that property, it's now worth $250,000, and you're selling that property to buy a house that's $300,000. So you don't have to pay that capital gains tax on that $150,000 that your house increased, which is a good strategy because paying taxes on a $150,000 gain is going to get really expensive really quick. You can also use depreciation. Now this one I'm going to leave for the advisor, but keep in mind depreciation is also and that's going to be for the building, not necessarily the land itself, but is something you can use as a tax write-off. Another pro, and as I mentioned in the beginning, is appreciation. Recently, here in Charlotte, I know specifically, the value of land has appreciated drastically over recent years. And really, over like the past year, I know my neighborhood's value has gone up significantly. And I wish I was a homeowner. I do still rent, but it's crazy just to watch how much these values change, and it could be based on anything from a highway going through, being built near the area. There might be a new shopping center that's being put into place. There could be a new train station or a light rail that's put into place. So there's a lot of factors that can increase the value of your property, and it's not something you really have to worry about the value of your property going down. Now, in some areas, it's going to be more drastic than other areas, but it is something that you can anticipate. Very rarely is the value of land going to depreciate. You also have leverage. So leverage basically is using somebody else's money. If you're going to buy a $100,000 house, most loans are going to require 20% down. So it only is going to cost you $20,000 at first to purchase that house. So you'll be able to utilize other people's money to buy more. What you can then do is refinance, especially if your house has increased. If you refinance, your house has gone up, and you can use that line of credit to buy other properties. That is something you can do in a margin account with stocks, but it's not recommended using other people's money for investing, because that's basically like using other people's money for gambling, where buying houses with financing or lenders or other forms of debt is a good strategy because it allows for you to build your overall value and acquire more properties without it costing you everything that you have. And lastly, you do have more control over it. So this does come with a cost. But if you want the house to be in pristine condition at all times, you want granite countertops, you want hardwood or laminate floors, you want a fence put up around the property, and you're going to charge X amount for rent, that's all on you. So you have that ability to make that decision of this is what we're charging, what I just said. Where again in stocks, you don't have any of that control. You really have no input when it comes to anything like that. So you have so much more control over your investments. I view that as a pro. I can see where some people would view that as a con, but it is something that a lot of people appreciate, and it's also just a tangible investment. You can actually go to a house and feel it and touch it and see it in person and make changes and paint it, where stock, it's not as tangible. You don't actually hold this. I mean, your account holds the stock. Nobody has stock certificates anymore, though. So, it's a little bit more personal when it comes to real estate investing. And with all that said, we'll go ahead and move on to the cons of real estate investing. Now, overall, real estate is a pretty illiquid investment, meaning it's not something that can be quickly turned into cash. So if you do need access to this funds, you're looking at easily 45 days before you'll see that money, and 45 days is probably on the low end. So bear that in mind as well, that you can't just quickly sell out of it. Stocks will take you about a week after settlement timeframes, and then for the money to hit your bank account. Where real estate, you are looking at a much longer time frame, which is why it's important to make sure that this is money that you won't need immediate access to before investing. It's also much more time intensive for real estate. You'll have to do research. Now, you don't have to do research. You can work with a real estate agent, and if you're in the Charlotte area and want to speak to me about that, I'll leave a link below for my site, so certainly feel free to reach out to me, and I'll be happy to go over market with you, help you look for properties, all of that. Sorry for the quick plug there. But you also have a due diligence period of making sure that inspections go through, that the house appraises for what you're paying for it, that the roof is in good shape, that the HVAC system is in good shape, things are up to date. Is there any lead paint in the house? Is there any asbestos to be aware of? So there's a lot more research on that end, as well as you have the closing time frame where it's just going to kind of extend everything out while you're still just waiting to actually get in this property and have it start cash flowing for you. There's also a lot more transaction costs when it comes to real estate, as well as those costs are significantly higher. So, when you're buying the property, you're going to have to pay closing costs, which, as I just mentioned, is going to be things like a title search, inspections, appraisals, checking for bugs or any other kind of damages with the property. As well as when you sell the property, then you're going to have to pay commissions to the sales agent as well as the buyer's agent. There's just a lot more costs that go into buying real estate. Now, again, the payoff is worth it in the long run, but it's not something where, from the example earlier, if your down payment is $20,000, that's how much cash you need to have. I'd advise having more like $35,000 to $40,000 because we don't know how much those transaction costs are going to be at the end of the day, as well as we don't know what kind of major expenses are going to come up that you will be responsible for. Overall, too, it's just a much larger investment. That 20% down. Yes, some people just have $20,000 sitting around. A lot of people don't. So it's just a more expensive investment and something just to be cognizant of before you start investing in it. Now, at this point, you're probably thinking, wait, Matt, how are we to the conclusion? I haven't heard anything about average rate of returns, and you haven't even put many numbers up on the screen. Usually that's what you talk about. Well, let's pump the brakes here. So, if you want a quick number, average return for the S&P 500 is about 6% annually. It changes each year. Real estate, I can't give you an average rate of return for because it varies from city to city, state to state, counties, everything. There's just such a large pool for real estate when it comes to average returns. Are we talking about cash flow, appreciation? So you can't really have an average number of what to expect without me knowing directly the area you're looking for and what kind of numbers it is that you want. Now, as many of you know though, I am a big believer in diversification. So if you're financially able, I would suggest owning portions of both. There's nothing wrong with spreading the risk. Each of them have their own things that they're going to be subject to when it comes to risk, whether that be market risk or the housing market. But it is worth spreading that risk across the table so it's not all in one place and hyper-focused on one area. That's where you get yourself into trouble. So owning both is a great strategy. If you don't have as much money to start investing in actual real estate, then I do consider, and yes, even during these times, looking at REITs, like the Vanguard REIT. And if you have any questions, I'll link my Vanguard video below where I did a full analysis of the Vanguard real estate ETF. But at this point, if you really want to know which is going to be the best investment for you to start with, I have a few guidelines. If you're busy, you don't have much time, you don't have much money saved up, or if you live in an expensive market, then I would suggest stocks. They're not going to take up as much of your time. You don't need as much money to put into it, and you'll start to see those returns a little bit quicker than you would with real estate. Now, on the flip side of that, if you have time, if you feel like you live in an area that's experiencing a lot of gentrification or have a lot of good deals in the area that you're in and have at least 30% of that purchase price saved up, then it is worth taking a look at real estate. But bearing in mind that real estate is a lot bigger of a commitment than buying stocks. So if you're okay with all of that, then definitely check out real estate because it's really going to help you grow your overall wealth very quickly. So both of them are really great investments to have. They each have a time and place and they each have their own purpose. But comparing the two of them is like comparing apples to pizza. It's just not a fine line between the two. They're so much different from each other, and really making a comparison video, I didn't want to say this at the beginning, it's just so hard because they're not the same by any means. They're both just ways of you making money, but so are lottery tickets. So you wouldn't compare a stock to a lottery ticket. So why are we comparing stocks to real estate? Well, because these are a little bit more promising of investments, and these are actual and genuine ways for you to diversify your portfolio. So regardless of which path you decide to take from this, the point that I want to make here is please do your research. If you have questions, talk to a professional, and an actual professional, not some self-proclaimed neighbor that knows everything about everything. Make sure you're talking to somebody who's been in the industry for a while with decent experience or has done deals themselves, so they can talk to you about the pros and cons. They're going to be the ones to really give you that tough love and tell you exactly how it is, and that's how you know you're getting good information. If somebody comes across and is like, yeah, I made $10 million off $3 last week in real estate, not somebody that I would really trust getting information from. But if it's somebody that's going to say, it's tough, it's time intensive, I spent hours working on this house, or I spend 5 hours a day researching stocks and I still end up losing money sometimes, that's who you want to be learning from, because they're there just to give you exactly how it is, not beat around the bush and be like, I did it, anybody can do it. And lastly, when it comes down to it, read and learn as much as you can about each. I've mentioned before, I'm not a big reader, but I like listening to audiobooks and I listen to a lot of podcasts. It's actually how I get a lot of my information, or I do research online, generally through credible websites like Investopedia. But learning is going to be your best friend here. You're going to want to have as much knowledge as you can about different areas and about different sectors, so that way you can start to form your own opinions, start to create your own strategy, and just learn what is going to be the best for you. So with that said, I'll wrap this video up. As always, I really hope that you learned something, and I hope that you found this video helpful. You could be anywhere in the world, but you're right here with me, and I really appreciate that. So thank you so much for taking the time out of your day to watch this video. Happy Memorial Day. I'm going to post this on Memorial Day, but I'm filming it the day before. If you want to subscribe, please go ahead and do so. It just helps me out a lot. And like the video if you found it helpful. But until next time, I will see you later.